BCM is privately owned and independent asset management company. It aims to generate superior returns over the long term at below average risk. The BCM Global Fund was instituted in 2006 and is now worth $323 million. The fund invests predominantly in large global companies listed on recognized exchanges across all markets. Joining us from our Cape Town studio is the group's executive chairman, Piet Viljoen. Piet, always a pleasure having you in the studio. Thank you. Let's look at the Global Fund, and your fund profile is sitting at moderate high. And I'm just looking at your exposure from a geographical perspective, sitting with around about 58% in the US. Perhaps just a little focus on the US and your thoughts about that territory going forward?
Yeah, well, I think it's more instructive to look at the underlying companies in which we're invested rather than the geographical spread, because you'll notice that some of our bigger investments there, like Johnson & Johnson and Microsoft, are actually global companies and operate across the globe, although they happen to be listed in the US. So it's not strictly speaking that we have 58% exposure to the US economy. I think if one looks through all these companies, it's probably somewhat less than that.
Well, let's focus on those stocks. And as you say, Johnson & Johnson is a major holding in that territory. Obviously, this goes with the theme that a number of fund managers are going with at the moment, and I know you don't like to follow the herd at all, so they're probably following you, and that is that developed equities that developed equities are offering better value than the local environment. Obviously this being a global fund, you're going to be focusing on global equities.
That's right. So in our global fund, we are predominantly invested in companies whose operating assets are predominantly in the US, in Europe, and in Japan. So we have almost no exposure at all to emerging markets generally, and specifically no exposure to Africa at all. We think assets in those markets are somewhat overpriced or priced for long-term below average returns, so we're avoiding those markets. And we are much more excited, to the extent that we get excited, we are much more excited about what's happening in Europe right now. From an investment point of view, we are value investors. We like to buy when prices of assets are below intrinsic value. That generally only happens when the news is bad. Assets are not priced cheaply when there is good news around. So, we like to look for the bad news. The bad news, obvious today, you look at the headlines, it's Europe. And that's where you're finding fantastic bargains.
Just very quickly, I know I'm going to throw it to Kevin in a moment, but picking up on that theme on Europe, how brave are you? Are you brave enough to go into European banks at this stage, Piet?
No, we're not brave enough for that, or foolish enough, depending on your point of view. We are more getting into unleveraged businesses that generate good cash flow and that are not dependent on potential government bailouts. And a lot of those sort of assets are priced at half book and less. The sort of prices you saw in Africa and South Africa 10 years ago. That's the sort of price to value relationship you're starting to see in places like Europe now.
But just you're looking at Europe and Japan as well. How are you navigating Japan in this kind of environment?
Okay, so Japan is quite interesting as well. We own a couple of the large companies, and we also have a relationship with a fund management firm there, Milestone Asset Management, to, on our behalf, manage a portfolio of small and medium-sized companies where we think the most value is in Japan. So we have almost 10% of our fund in small to medium-sized Japanese companies, which are on average trading at multiples, EV to EBITDA multiples of less than 5, price to book of 0.6 times. And these are good quality businesses. So we're very excited about that as well.
Then just looking at the cash ratio in the portfolio, I see it's just marginally up from last year. I've heard in the past you've referred to cash as deferred alpha. Historically, how much cash have you had on the portfolio? If you can just give a range of how high and low it's been, and then just when you look to deploy that.
Yeah. So when the cash position in the fund is not a top-down allocation. It's basically a position that falls out from our ability to find cheap, good quality investments. And to the extent we can find lots of them, we'll have a little bit of cash. Today we have a moderate amount of cash, around 20% of the fund is in cash. and that speaks to our inability to find lots and lots of high quality, good value propositions. In 2000 and late 2007, early 2008, I think we had about 40% cash in the fund. Assets were much more expensive then. Right now, assets are expensive, but there are pockets of value. In 2007, early 2008, assets generally were just expensive. So it's slightly different. We have less cash than then, but we're still not fully invested, which tells a story of, there are good ideas, but there's not like unlimited good ideas right now.
In terms of the good ideas, and if you look at your top 10 holdings, for instance, has there been significant rotation? Or I suppose, Piet, given that you are long-term value managers, you hold your position for relatively long periods of time. So if you look at your top 10, are these the top 10 that we were looking to in April 2011, April 2010?
Yeah, there hasn't been much change there. I think one of the big changes that's happened over the past 2 years is we have a lot more US technology or technology in general in the fund, whereas 3, 4, 5 years ago we had a lot more defensive type situations, consumer staples, those sort of Heinekens, those sort of stocks in the fund. Those, in our opinion, have generally become fairly expensive. And the more cyclical type of companies, like technology companies, have become a lot cheaper. So we are much more exposed to that side of the market. I think wherever you look today, it's almost a mirror image of what was going on in markets 10 years ago. 10 years ago, South Africa was completely out of favor. I think there was a cover on The Economist of Africa, the hopeless continent. That was a cover in The Economist 10 years ago. Nobody wanted to be in South Africa. All the South African corporates were buying headquarters in London and diversifying into the US. Everybody wanted technology, pharmaceuticals, and nobody wanted anything to do with emerging markets. Today, the reverse is true. Everybody wants to be in emerging markets. They want to be where the growth is. They don't want to be in cyclicals, albeit mining or technology or anything like that. They want to be in Africa, they want to be in South Africa. And as you said earlier on, we generally steer away from what the herd wants to do. Longer term, we find it much more profitable to be where nobody else is. And that's why we find ourselves in the more cyclical side of the market, the technology companies, the developed markets, places which are under stress like Europe.
Piet, just looking at those technology companies, I see that Microsoft is your fourth biggest holding. Can you just explain to investors why you'd prefer Microsoft over, say, Apple at the moment, which obviously is very popular at the moment, even though on a relatively undemanding PE of 12, though?
That's right, yeah. Look, that's a good question. Microsoft, to us, if you strip out the cash in both Apple and Microsoft, Microsoft is cheaper. It is a business that is probably more pervasive in the business communities globally than Apple might be. Apple is more of a consumer type situation. But having said that, it's not clear that Apple is multiples more expensive than Microsoft. We think Microsoft is marginally more cheap, and that's why we hold that one.
Piet, also just cognizant of the uncertainty in the global environment today, I know you ignore the short-term noise, but if you look through this downturn, you could potentially pick up some of these stocks, or maybe you'll add to your holdings in these stocks, because we could see further downside. That's really what I'm getting to. The uncertainty could create further opportunity for you.
Yeah.
Will you be accumulating your positions?
Yeah, the lower prices go, the more we buy, and conversely, the higher prices go, the more we sell. So we try not to forecast the future and act on our forecasts, because generally we get that completely wrong. We have no idea what the future holds. We rather respond to price movements. So when bad things happen and prices decline, we tend to act and we tend to buy if prices are far enough below intrinsic value. So we reactive and not proactive in the sense that we're not trying to guess where markets are going and then position ourselves accordingly. Because we have opinions about those things, but our opinion is as good as anybody else's opinion, and that's not very good at all.
Piet, you've had an extremely good career and you've developed a phenomenal reputation. What advice do you have for potential investors out there, I know you spend a lot of your time managing money, but sometimes you've got to manage people's expectations as well. What advice do you have for people who are looking to invest money, but need to realize that they're going to be in for a ride?
That's a great question, and I think the most important thing is to try and switch off the noise. Try and get away from the excitement, try and get away from the hype, because Wall Street or Maud Street in South Africa is geared to separate you from your money. It's all bells and whistles, flashing red and green lights. It's almost like a casino. And you need to be able to shut yourself off from that noise and that excitement and make rational decisions. And if you can do that, you are 90% of the way there.